was principally a long investor for the first 10 years of my investment career. And then in 2002, I came across a company called Farmer Mac, which is a GSE not that different from Fannie and Freddie, but that operates in the agricultural market. And was recommended to me as a long investment, something I should buy. And the more I looked, the more I concluded that this was a good short. And without going into too many details, I bought a credit default swap, and it turned into a profitable bet. I then looked at Fannie and Freddie, and actually in 2002 made short bets through the credit default swap market on Fannie and Freddie, but ultimately gave up because I thought of them as sort of too big to fail. But as part of that research, I was looking for other companies that had AAA ratings where perhaps they didn't deserve the rating. And I came across a company called MBIA, which is a bond insurer. And it's a company that started out in a very low-risk business, guaranteeing California bonds, for example. And over time, what you see with financial institutions is that as markets become more competitive, they're sort of forced to take on more risk to make their shareholders happy. And the bond insurers were started out as almost cooperatives. They weren't for-profit in the conventional sense. But in the early 90s, most of them went public, and they had demands from their shareholders, and management was compensated with options, and they started to look for other avenues for profit. And they had a AAA rating from the rating agencies. So Wall Street sort of got a hold of them and said, look, you guarantee California bonds, you guarantee hospital bonds, why not guarantee corporate risk? Why not guarantee mortgages? And over time, they started to enter a market they knew less well. And they're very leveraged companies. What struck me when I first opened the annual report of one of these companies is they had a AAA rating, yet over 100 to 1 in leverage. And that just didn't...
It's out of this,
didn't compute.
It's just unbelievable. It doesn't compute. Yeah.
Right.
I mean, we think of 30 and 40 to 1 as high.
Yes. And, but, the world up until recently was a world that believed. The financial markets were...
What does that mean, the world that believed?
Where investors would buy a bond based on its rating. They'd buy a CDO, they'd buy a complex security. It was sort of too difficult for them to analyze. And they outsourced the analysis to 3 companies, the rating agencies, Moody's, S&P.
One person after another has come to this table and just cast huge criticism at the ratings agencies.
Yes.
It's all deserved.
It's deserved.
How did it come to that?
I think the rating agencies perform what amounts to almost a regulatory function. Determining the creditworthiness of a bond is something that the SEC uses to determine the capital adequacy of an investment bank. And so they got a almost sovereign-like status, but they were for-profit entities. And that for-profit nature of what is a quasi-regulatory body caused them, I think, to push for production and, the incentives of trying to meet next quarter's earnings can cause someone to, in a competitive marketplace, perhaps to sign off on a rating that wasn't deserved. There was a lot of rating shopping. An investment bank would walk into Moody's and say, look, here is a risk. We're looking for a AAA rating, and it would be analyzed by Moody's, and they say, okay, it's AAA. And then the investment bank would say, well, what if I throw this in? Is it still AAA? And they would say, looks AAA to us. Well, what if I threw in a few more bad mortgages? Is it still AAA? And at some point, Moody's would say, it's no longer AAA. And they say, okay. And then they walk across the street to S&P. And S&P would say, they'd take a look at it. And if they said yes, they get paid a $600,000 fee. Yes, it's AAA. If they said no, they wouldn't make any money. And I think,
So that raises the big question, what's going to happen to ratings agencies?
I think they become a lot less relevant, although...
And people have to do their own credit analysis. Is that the idea?
You can't outsource credit analysis. It's the major. The problem with the rating agencies is that these monikers, the good housekeeping seal of approval of a AAA rating, has lost its value, and that was exported around the world. So this U.S. It's almost like regulators around the world deferred to the rating agencies, and that caused securities that probably should not have been sold to spread around the world. And the crisis that we're in now is largely because people took their... If you think about the internet bubble, when people lost a lot of money, it wasn't as bad.
Because there was no earnings.
Well, the internet bubble, people were taking not their savings they needed to make mortgage payments. They took their highest risk assets. They knew they were taking risk when they were buying flues,
right. Well,
at 100 times
they're betting
revenues.
on the come, so to speak.
But people who invested in AAA obligations, these CDOs and asset-backed securities, took their lowest risk money. It was the money that banks didn't have to hold capital against. It was the retiree who said, I want to make sure I've got enough for my retirement. Right. And the result is people have lost confidence because they took their safest most important nest egg funds. They put it in stuff that's supposed to be risk-free, and it turned out to be far from risk-free.
A couple of things. One, how much redemption is going on with hedge funds?
A lot.
Yeah, and explain what that means.
Hedge funds are not, the capital isn't permanent.
Right.
It's a little more permanent than a mutual fund. You could call up Fidelity and tomorrow you can liquidate your entire account. With a hedge fund, you have to give notice. And it depends on the fund. Some funds have 5-year lockups, some have 2-year lockups, some have 90-day lockups. And as investors have lost, hedge funds have lost money, this year, perhaps you're right, the average hedge fund might be down 20 or 25%. Investors are concerned. They're looking for sources of liquidity. And they put in a redemption notice to a hedge fund. What that means is the manager has less money. Yeah. It means he has to sell what he owns to make good
in order to pay back the guys or the person's.
Which puts pressure on the market, which puts pressure on funds, which causes more redemptions.
You know a lot of people that are experiencing terrible margin calls?
No, I actually don't hang around with people who use a lot of leverage.
Really?
Really. There has been too much leverage in the system.
And, and that's where they got caught.
It's coming out.
Now, in Washington this week, I just saw this over the weekend, you got 4 of the giants are going down.
Yes.
The guy from Renaissance, what's his name? James Simons. The guy from Citadel, what's his name?
Ken Griffin.
And a couple of others.
Yes.
And 4 of the majors.
Yes.
And they're going to, I guarantee you, that's going to be rough sledding for them.
Yeah, I'm sure.
When they get to Congress.
I don't think they did anything wrong. They made a lot of money.
I don't mean in particular. They're the ones who compete there because they're prominent.
I think what people...
What do you think Congress is looking for?
They're looking for a scapegoat.
Really?
But if you look at the average mutual fund, as much as the average hedge fund has done poorly, the average mutual fund has done much worse. People sort of demonize hedge fund managers because they tend to be well compensated, perhaps overly compensated.
You throw that word around, well compensated. When we read these stories about people making hundreds of millions of dollars a year.
Right.
I know people,
It's a handful that make hundreds of millions.
Even a country boy like me knows a bunch of people that...
Sure, but if you look at any line of work, the top people in the profession make a lot of money, whether it's entertainment or CEOs of companies, the occasional author. But
I know not many CEOs are taking $100 million home.
And there aren't that many hedge fund managers that take on $100 million.
Fair enough.
But I think the focus should be less on the manager than who they manage money for.
Exactly.
The investors are, the Carnegie Halls of the world, the St. Luke's hospitals, the state pension funds. And so I think the SEC did a good job destroying a lot of opportunistic capital by putting in place a short selling ban without notice. And they caused a loss of confidence in the U.S. securities markets because the rule of law, why do you invest in the United States markets as opposed to in an emerging market? Because you have confidence the rules won't be changed. Well, the rules were changed. It caused hedge funds to lose a lot of money. The most opportunistic capital in the country, which is hedge fund capital, has been damaged. Why do you think the market has continued to decline since that point in time? It's because the people who are normally be jumping in to take advantage of what Buffett calls one of the best opportunities to invest in his lifetime is they can't. They're on the defense because they're getting redemptions.
Yeah, this is a time of opportunity for people with money, is it not?
Absolutely. It's the single best time in my career that I've seen to invest.
To invest money. There's more value out there than you could ever imagine in terms of...
The spread between price and value is the widest it's been in many years, 30 or more years.
Prices are way below value.
Yes. Not every case.
But why do I hear so many stories, I am a babe in the wool here, about people sitting on cash, They're just sitting on it. Now, you're saying there's tons of great investments to be made, and there's a greater spread between value and price than there's ever been.
Yeah,
and yet they're sitting on cash.
Yes. A couple of reasons. One, if you don't know how much money your investors are going to ask you for, you have to put aside money to take a conservative point of view. Very few people have permanent capital. Mr. Buffett is about the most fully invested we've ever seen him. Right? He spent $50 billion in the last few months. It's hard to keep track.
Right.
He can do that because his capital is permanent. Most investors in the marketplace, mutual funds, hedge funds, managed account managers.
And his capital comes from money that comes into
every
Omaha
day
from businesses he owns.
That's right. And that's unusual. And so in a marketplace where your capital isn't permanent, people have to be on the defensive.
Let's talk about regulation, first of all. Take credit swaps.
Credit default swaps have historically been a largely unregulated part of the marketplace.
Right. And they should be regulated.
I think so.
And what else? And how should they be regulated?
Well, the problem, what's interesting is it's really the combination of the rating agencies and credit default swaps that got us into trouble. The institutions that have created the systemic risk, if you think about them, it's AIG, It's Fannie Mae, it's Freddie Mac, it's MBIA, it's AMBAC, it's the bond insurers collectively. And what do they have in common? They all had AAA ratings. Why did the ones with AAA ratings cause systemic risk? The answer is, unlike the other participants in the market, they got a free pass. So for example, if I buy a credit derivative, I have to post collateral to Goldman Sachs or Morgan Stanley equal to what I might have to pay Goldman Sachs if I had to unwind the position today. And that's a very good discipline, because Goldman Sachs is only one day away from what they could get paid if something were to happen to my firm. The AAA firms were given a free pass. They didn't have to post collateral. So at AIG, they had a subsidiary in London run by a relatively small team that wrote $500 billion of this stuff, and they were collecting money every quarter. And the CEO was saying, this is a great business. I put up no capital, and money just comes in the door. I never pay claims. The problem is they're paying a lot of claims. And the problem is that now that they've been downgraded, they have to post collateral. But they didn't have enough money. It's almost like someone writing hurricane insurance, and the problem is when the hurricane hits, they don't have the money.
Okay, so we know that AIG is coming back and asking for more money. We know that as of news this week.
Yes.
Secondly, you believe that Fannie Mae and Freddie Mac, what's happened there, well, it's like a Band-Aid.
Yes. Yes.
So what should they have done?
I think it's pretty straightforward, and I'll try to make it straightforward for your viewers. But we have this great thing in America, which is we have a system where it's not illegal to run out of money. We have a system to reorganize companies. It's called the bankruptcy system. And in the case of an agency like Fannie or Freddie, it's called conservatorship. So I think Secretary Paulson did the right thing, putting them first into conservatorship so he could reorganize the companies. But he really stopped there. He didn't reorganize Fannie and Freddie. And what he should have done, what he did was he said, look, I'll protect the debt, the senior debt and subordinated debt of Fannie and Freddie, and I'll commit to fund $100 billion to keep them just above solvency. And the problem is he left institutions with a capital structure that they couldn't support. Fannie and Freddie have way too much debt versus the value of their assets.
Right.
And what we do when a private business finds itself in that circumstance is the company goes into bankruptcy, the equity holders get wiped out, the creditors end up owning the business. So if a business had $1 billion of debt and now it can support only $500 million, it comes out of bankruptcy with $500 million. The creditors give up their $500 million of debt and they end up owning the company. The company emerges with a balance sheet that can support its business. They give equity, they typically hire a new management team, and they go on with life. If you look at what happened to Fannie and Freddie, they became government agencies or government-run companies. They're no longer traded on the exchange. The equity holders, the option plans for management have been wiped out. They have too much debt. I actually saw a story on the way over here that Fannie Mae put out a filing at the end of the day saying the $100 billion is not going to be enough, and we can only sell 1 year debt. And so here's what we recommended. We said, look, Fannie and Freddie have $1.6 trillion of debt outstanding. What the government should do is, number one, you might want to combine Fannie and Freddie because they perform the same function and there are a lot of efficiencies in the combination. So make them as efficient as possible. Number two, take the $1.6 trillion of debt and convert 20% of it into equity. So you'd raise $320 billion. And then they could reemerge as listed companies on the stock exchange, and they could go back to running business as strong, well-capitalized companies. Fannie and Freddie have all the money they need. The problem is too much of it is debt and too little of it is equity, and you just need to restore the balance. And you wouldn't ever lend money to an insolvent company so it can pay interest to its former creditors. What you would do is, before you put in new equity or new investment, you'd reduce the debt so it could support the debt. And that's what they should do.
And did you write a letter to Secretary Paulson?
I did more than that.
What did you do?
I put together a little presentation. I sent it by email to the Treasury Secretary and the staff. And I spoke to some officials at the Federal Reserve Bank and at the Treasury. And I was actually told by one of the members of the staff that it was one of the plans that they considered seriously, but ultimately opted to go with theirs.
So where do you think we are today?
I think we made progress, and let me be complimentary of our regulators. I think what started out as
regulators or the Federal Reserve and the Secretary of the Treasury?
I'll say the Federal Reserve and the Secretary of the Treasury. If I focus on the TARP,
okay.
The $700 billion that authorization from Congress, I think so far has been spent well. $250 billion going into some of the best banks in the country, so they've got more capital to lend, so that there's more confidence in your counterparty is a very important first step. So I like that. Second thing is the government taking steps to cause the rate at which companies borrow to decline. So the LIBOR rate versus the the interest rates, that the Fed funds rate that spread has narrowed, which means that the cost of funding for businesses has come down. That's a positive. So I think we've taken some positive steps. I do have some concern about what you read about in the newspaper in terms of other things they're thinking about.
Like?
I'm concerned about GM. And why am I concerned?
GM, the car company.
Yeah, well, I mean, I guess there are reasons to be concerned, but this is a very important company for the country. It competes in a global marketplace. It's been hamstrung for years because it has too much debt and it has contracts that are uneconomic.
It's in the healthcare business.
That's right. And the way to solve that problem is not to lend more money to GM. That just creates another Fannie or Freddie problem. The way to solve that problem is to use the reorganization system of the country. And I don't think...
Okay, so reorganize GM for them.
What should happen is they should do a prepackaged bankruptcy. The equity holders have been largely wiped out already.
Because the stock is selling at, what, $2 or something?
Yeah, I think.
What is it?
It's a $4 or $5 stock
right.
today. It's maybe a couple $2 billion market cap.
Right.
The debt trades at 30 cents on the dollar.
You could buy all of General Motors for $2 billion.
Yeah, and you're overpaying.
And you're overpaying.
You're overpaying. What they need to do is...
Is that why nobody's bought it?
Right. What you need to do is reduce the amount of debt at General Motors to a level that the company can support. And the debt holders, in exchange for giving up their debt claim, will end up owning the business. What you want is a General Motors that can compete. You don't want to lend government taxpayer money to an insolvent company so they can pay interest to the people who lent the money 5 years ago. Right? That's not a solution to the problem. I'd rather the government's money be used to retrain employees for other jobs, for infrastructure. You know, the welders at General Motors can help on the infrastructure of the country. That's a much better use of taxpayer money than lending money to an insolvent company. So we can't be afraid of the bankruptcy word scares people. It's simply a system.
Yeah.
And I have no economic interest either way in General Motors, but I guess for the good of the country, I have an interest in General Motors. I'd like to see General Motors have a capital structure.
Should it merge with Chrysler?
If that would make the company more efficient, it should. It's just like Fannie and Freddie. You've got two companies that effectively perform the same function. My guess is there's significant synergies.
Well, what about Ford?
If it makes sense, I think we should design...
One great American auto company.
We should design an auto company that can compete on a global scale.
So you buy into the recapitalization program when you think the auto companies ought to be reorganized.
Yes. There's a viable business at General Motors, but it needs a different...
So it seems like what you basically are saying is that the federal government is making a mistake.
Yes.
And the Congress is making a mistake. If, in fact, they think that just pouring money into AIG or into General Motors will solve the problem.
AIG is a little different from the other two.
Right.
But you have to start with, once you're done with the taxpayer putting in... I mean, if you look at the bank bailout, it was done very well because the government didn't go invest. It put preferred stock in only solvent institutions, right? They're letting, 17, 18 banks have failed. They're letting them fail because there's no hope of rescuing them.
Should Lehman Brothers have been allowed to fail?
It's a complicated question. I would say my regret with Lehman Brothers is once Bear Stearns was saved, the message on Wall Street was, we're going to let shareholders die, but we're going to protect counterparties. As a result, when Lehman failed and the counterparties lost 90 cents on the dollar, more money was lost, in my opinion, than should have been lost. If the government had said, look, we saved Bear because we didn't have time to figure it out, it was over a weekend, they had plenty of time to know that Lehman had issues, and they should have let the market know. This is the last, we're not going to save every counterparty.
Well, my impression is Lehman went around looking for buyers, and in fact there was a South Korean buyer that might have been in place for a while, et cetera, et cetera. Right?
Apparently Buffett made a proposal that was rejected. I mean, I think Lehman could have been saved, but I think the management loved their institution too much to take money on terms it thought was unfair, and ultimately it cost the institution.